Welcome to The Untaxables, the podcast where smart entrepreneurs get strategic, stay compliant, and keep more of what they earn. I'm Haley Kirka, enrolled agent and owner of Noble Tax and Accounting, and I believe that you can spend your money better than the government ever could. Here, we make tax strategy digestible and approachable, building smart, simple systems that save our clients thousands every year. Get smart, get strategic, get untaxable. Well, hello and welcome back to The Untaxables. Happy New Year. It's January 2026 and I'm so excited. I love the new year. I love it. It makes me feel so hopeful, so full of possibility. The potential is just so exciting. So I hope you're feeling the same things. I have tons of goals and aspirations for this year, and I think it's going to be a great year, and I'm excited to see what it holds. Today, I'm also excited about this episode because we get to talk about the One Big Beautiful Bill and some of the tax law changes that have come into effect with that. And we're not going to get into everything because there's a lot there, but I'm going to highlight a few things that I pulled out that are interesting to me and I think will be applicable to my listeners here on the show. And so as we go through this, just know that this again is an overview. It's not a deep dive on any one of these concepts or changes. And I did want to just let you know that I am going to be doing full-length episodes here on The Untaxables about very specific parts of the One Big Beautiful Bill that are going to have a lot more nuance and also applicability to my client base. So those are going to be coming out soon. We're going to do one on no tax on tips moniker and also the no tax on overtime. And we'll add a few others as time goes on. But those ones are in the works and we're going to get those out here as soon as possible. So just keep in mind there's a lot of misinformation about these ideas going around. And so be careful what you're trusting in terms of your sources and that kind of thing. And just be aware that when your return is prepared, things might shake out a little bit differently than you expected. With no further ado, let's get into this. These are the things that we're going to cover today. We're going to talk about the new Trump accounts that are established for children. We're going to talk about vehicle interest deduction. We're going to talk about the qualified business income deduction being made permanent and bonus depreciation being made permanent. And finally, I'm just going to go over a few things with deduction change or standard deduction changes and charitable contributions and that kind of thing. So we have a lot to cover. Let's get started. Let's just dig in. So I'm going to start with the Trump accounts. That's kind of going to be where I spend some time initially here so that we can kind of look at what these are and what they mean. First off, it is a special kind of IRA. So an individual retirement account arrangement. Basically, it has its own special set of rules for what's considered the growth period. So that's going to be between the ages of, or the inception of the account to the age of 18 for the child. And during that time, they have special rules. And then they kind of go into being covered under a lot of the same rules as traditional IRAs with exceptions. There's always exceptions to tax law. So I'm not going to talk so much about after the growth period, just kind of getting started in what we know now. A lot of this guidance and how it's actually going to apply in real life is still being drafted and is not even finalized yet. So there's still comment periods being that are open and getting feedback and that kind of thing. So first things is there is no earned income requirement for a Trump account. And that's just different from an IRA because IRAs do have an earned income requirement. You have to actually earn income to be able to make a contribution to a traditional IRA. And in this case, you don't have to do that because they are specifically set up for the benefit of children or minors. They have to be invested in eligible investments. And typically this is going to be a mutual fund. And because there is that specificity in the law about what they can be invested in, this is going to keep it from being eligible for something like a self-directing arrangement or anything. So there are pretty narrow requirements for what it can actually be invested in and how that's done. Okay, a couple other things. They're available for children born between January 1st, 2025 and December 1st, 2029. So there's just this period of time where new children that are born in the United States have the benefit of a Trump account. And the child has to be a U.S. citizen. They have to have a social security number. The kind of the thing that has been in the news a lot has been the talk of the $1,000 seed money, if you will, that the federal government is going to be putting into the accounts. And that is true. That is available. There does have to be an election made for that to happen. It's not automatic. So the Trump account has to be set up with very specific language in the plan documents of how it's structured, what the reporting requirements are, all the things. But also an election has to be made by the beneficiaries' parents or guardians, custodians, all of that, any of those items. And that has to be done on IRS Form 4547, which I think is fitting. I'm sure they actually did that on purpose, but 4547. And that is going to be also, there's also going to be an online mechanism for making that election. And again, these things are still in the works of what that's going to look like. We don't have the forms available yet for review. Deposits of that pilot amount, that $1,000, are going to happen no earlier than July 4th of this year. So July 4th, 2026, and then are just going to occur as accounts are set up and the election is made. The other thing is that with these accounts, you can, as an employer, contribute to the accounts of your employees' children. So if you have employees who have children who have this Trump account, then you are actually able to make that contribution into their account via payroll. And that's not included in income for the employee. And it is a tax deduction for you as the employer. So that's something to think about if you want to provide as an employee benefit, Trump account funding for your employees' children. The caveat to that, and something that is pretty much the case with any of these kind of fringe benefits like dependent care assistance programs and different fringe benefits, if you're a greater than 2% shareholder and employee of your S corporation, which if you're an S corporation owner, you're most likely going to be more than 2% owner, then these benefits aren't going to apply the same way to you and you're not going to see the same tax benefits. Parents can make contributions to the Trump accounts, and that is going to be an aggregate contribution limit with the other employer contributions. Both those together, the aggregate contribution limit is $5,000 a year. And on the employer contributions, so if you're an employer making contributions to your employees' kids, then that is actually going to be capped at $2,500. And for clarity, I wanted to mention that $2,500 limit is per employee, not per employee dependent. So if you have an employee who has 2 children, then you can't do $5,000 contribution to their accounts. You can still only cap that at $2,500. So that's something to keep in mind as you're potentially thinking about this as a tax deduction. It really is capped at $2,500 per employee. The child cannot take distributions during the growth phase of their Trump account. So again, that's ages 0 to 18. No distributions can be made. And then after that point of being 18, the account kind of transitions into following the distribution rules of a traditional IRA. So that's the overview. There's a lot there. There's a lot that we could get into a little bit more deeper on that. But I wanted to give you an overview so you kind of understand. There's going to be questions at tax time about this, and I just wanted to kind of get that out there so that we can cover those kind of the simple bases and know what we're dealing with here. Okay, going to move into vehicle interest deduction, and this is interesting. I personally don't really love it, but I'm going to talk about it because it is a change that happened with the One Big Beautiful Bill that you should know about. So this provision essentially is based off of the idea that personal loan interest is not tax deductible. So we're talking personal credit cards, personal loans of any kind. The interest on them are not deductible to you as a taxpayer. Vehicle interest loan for a personal vehicle has always fit into that category and has not been deductible, at least in recent history. So the One Big Beautiful Bill actually addressed that and changed that provision. So it opened up the deductibility of personal vehicle loan interest. And now you do have the ability to deduct loan interest on that. There's caps, there's thresholds, there's all that. But the cap is $10,000 that you can deduct in a tax year. That starts this tax year, so 2026, not applicable to 2020. And the vehicle, there's a couple really specific things. The vehicle has to be brand new. So you have to be the original owner of the vehicle, and it has to have its final assembly done in the United States of America. So the idea behind this was really to incentivize American-made vehicles. And to do that, they said, well, at least the final assembly has to be done here in the US to qualify for this interest deduction. And this is pretty broad. It covers many, many types of vehicles, cars, trucks, SUVs, motorcycles, and it even covers motorhomes, travel trailers, and ATVs. So if you are planning on purchasing a vehicle and you're a person that buys a new vehicle and you get a loan on it and it's made in the US and all these things line up, then you may be eligible for that up to $10,000 on the vehicle loan interest as a deduction. So that's something to keep in mind. I love QBI. QBI is Qualified Business Income Deduction. It's Section 199A, and essentially this was established under the Tax Cuts and Jobs Act back in 2017 that 20% of your business income can be deducted as an expense or as a deduction. And has been just widely beneficial for American small business owners, and I've seen it make a significant tax impact on my own clients, and everybody loves it, right? Everybody loves a good deduction, and this is pretty broad based. Again, nothing is just like, oh, here's a 20% business deduction on business income. There are caveats and rules and exceptions and exclusions and thresholds and all the things. But it does apply to many, many, many small business owners and the income that they are generating from their businesses. So it's a very good thing. It was set to expire at the end of 2025. So we were going to see that go away, not be there anymore as a deduction. And the One Big Beautiful Bill changed that. And so one of the provisions was to make the qualified business income deduction permanent going forward. So I'm celebrating that. It's my favorite part of the One Big Beautiful Bill's changes, and I think is probably going to have the most impact on the widest number of American taxpayers, especially in the realm that I serve with small business owners and entrepreneurs. Bonus depreciation is kind of similar to that in that it was established in the Tax Cuts and Jobs Act and was set to expire or was actually expiring. It was kind of phasing out. It was like first it was 100% bonus depreciation, then it went to 80, 60, that kind of thing. And 100% bonus depreciation with the One Big Beautiful Bill is back. So we have that again, and that's going to benefit a lot of taxpayers as well. And that will apply for the 2025 tax year as well. 29 plan changes. I want to touch on this, even though I don't want to go in too much into depth in this because it could kind of open a can of worms on what these plans are and what they mean. But 529 plans are education savings plans, right? They allow you to make contributions, and those distributions can be taken out in form of paying for qualified higher education expenses like tuition, books, dorm fees, that kind of thing. And when those distributions are taken for those qualified expenses, there's no tax penalty on those distributions. That's always been a pretty narrow definition of what qualified higher education expenses are. And the One Big Beautiful Bill has broadened that somewhat, and now it will include private and homeschool items. So if you're a homeschool family, this might be really intriguing to you. And you can there are certain things that are going to qualify now as tax-free distributions from that account that will cover potentially curriculum and tutoring and lessons and some supplies and that kind of thing. Now, this is going to mostly benefit those who already have 529 plans established and that's kind of already part of their tax life and their financial situation. But it might also open the door for some additional tax planning strategies surrounding education savings, especially when we think about what are the goals for each family and how many children they have and what kind of funding they want to do and that kind of thing. So I'm going to be digging into that a little bit more as we go forward and really getting into the nuances of what the changes mean and what are qualifying expenses that will be covered by or if you're a homeschool family. And I'll say that I'm a homeschool mom. And so I'm particularly interested in, could we have 529 plans that actually are paying for qualified homeschool expenses? And what does that look like and all of that? So I want to look into that a little bit more and actually get you some more information on that because I think it might apply to quite a few people. Okay. A few other things that I'm going to cover. The standard deduction has increased. We all expected that, all knew that that was happening. So this year, 2026, the standard deduction for a married filing joint couple is going up to $31,500, which is beautiful. And we'll continue the trend that we've already seen since the Tax Cuts and Jobs Act, which is that fewer and fewer people are itemizing their deductions and more are taking the standard deduction just because it is significant. Senior taxpayers also get a special extra deduction for a few years, 2025 through I think it's 2028 or 2029. They get an extra $6,000 per taxpayer. So senior couple that's married filing jointly would actually get an additional $12,000 in addition to their standard deduction. So nice little benefit there for those older than 65. And a few other rules on, or changes really, on charitable giving. So generally, you kind of are looking at, is it more beneficial to take the standard, or is it more beneficial to take or to itemize the deductions? And the biggest expenses that make up the itemization is going to be mortgage interest, property taxes, charitable giving, and then to some extent medical, but not as much because we have some floors to work around there. But now with the One Big Beautiful Bill, there's a new provision that says that you can take the standard deduction and also take an additional deduction for charitable giving that you gave to eligible institutions. So this is $1,000 per taxpayer, $2,000 for married filing joint couples. If you gave to at least if you gave up to $2,000 and are taking the standard deduction, you can deduct that $2,000 in addition to your taking the standard deduction. So I think that's pretty cool. It was something that I'm going to take advantage of. And I think a lot of my taxpayers that I work with and serve are also going to find that beneficial. So it's not a huge amount when you're talking about a deduction, but every little bit helps. And so I was excited to see that change. If you are itemizing, the rules for itemizing and taking charitable contribution deduction has also changed somewhat. One of those changes is that there is now an AGI floor to work with or to overcome, essentially, before you can deduct. So what that means is you have to have greater than 0.5% of your AGI in charitable giving before it starts becoming deductible. In a scenario example would be if you have $100,000 of AGI, the first $500 of your charitable giving is not going to be deductible, but after $500, it is still remaining deductible. So that's something to think about. It's not a huge floor to work with. Those AGI floors, like for medical expenses, are a lot greater, but it is something to be aware of and something to watch out for, especially will impact the higher income earners for sure. So that is all that I have for today. I hope it was helpful. Just a quick overview on what some of those changes are and what you should be looking out for in terms of upcoming episodes where we really dig deep into some of these topics, especially surrounding no tax on tips, no tax on overtime. Keep an eye out for those. And then coming up this quarter, we are really focusing on a theme of planning to prosper, really just focusing on the aspects of strategic tax planning versus just looking at compliance, which is what we talked about in prior episodes. So with that, thanks for tuning in. I'm always happy to share any knowledge that I have with you, and I look forward to the next time.
Thanks for tuning in to The Untaxables. Be sure to like and follow our show, and tune in again next week for more tax tips that keep your hard-earned dollars in your own pockets instead of sending them off to Uncle Sam. Until next time, get smart, get strategic, get untaxable.